Hi, everybody. Welcome to the Future Podcast. I'm your host, Sean Donlan, here with a very special guest today, Rabbie Gill, Portfolio Manager at Fieldhouse Capital. How are you, Rabbie?
I'm well, Sean. Thanks for having me here. Hope you're keeping well.
Yeah, great. Yeah, thanks a million. So to give you an overview of the podcast and for any new listeners, this is a podcast where we speak to professionals in different industries and we kind of get their view of their industry, what they're experiencing at the moment, a little bit of their background and kind of what their plans are for the future. So tell us a little bit about yourself, please.
Great, thanks, Sean. Well, I'm a discretionary portfolio manager with Fieldhouse Capital here in Vancouver. And as a portfolio manager, what I do is I have a fiduciary duty to invest and act on the best interest of my clients, which is a little bit different than what a typical investment advisor or a stockbroker does, which buys and sells securities on behalf of clients. On the personal level, I'm married, have two young boys, Aaron and Roman. They're twins, 10 years old. I coach a lot of baseball and soccer with them as well. Last couple of months, things have kind of come to a standstill, so it's been
Twins,
more
that's
just
a lot
in the
of work.
backyard. It is, but it's fun. And they're two different personalities, so it's quite interesting to see them grow up. You see bits and pieces of yourself in them, and the contrast as well.
Yeah, fantastic.
Yeah. So recently, in just January 2020, I've launched the Total Return Global Macro Fund and started a private client management practice as well in 2019. I spent a number of years, 17 years of experience working for large organizations, and I always knew that there's a better solution to help more people both grow and manage their wealth. And I'm of the opinion that it's all about the process. So you really need to get to know your clients, and your clients need to understand your investment process. So they can connect, and they also have the confidence to understand how your portfolio is positioned and how they're going to change throughout the business environment. And there can be no better time than right now with the COVID crisis and the economy slowing down.
Yeah. Okay. Obviously we're in totally unprecedented times at the moment with the coronavirus, the economy. How has that impacted your business, your fund? It's an interesting time to launch a fund.
It has been, and thankfully, it's been very positive for myself and the fund. We've been positioned relatively well. Volatility is really our friend with the investment process that I have, and really, when it comes down to the nuts and bolts of it, we're risk managers. And the ironic thing is that when a lot of people think about investments, when things look the best and things are kind of plugging away with no interruptions, that's actually when things are the riskiest. And the opposite's also true. When things are actually the worst, it's usually the best time to invest. So, over the first 3 months of the year, the Global Macro Fund has returned just over 23%. And throughout 2018 and most of 2019, we started to get defensive as we started to see more and more risks, especially on the equity side. Our investment process kept us on the right side. Our average client portfolio is up double digits, 12 to 15%, depending on when they move their assets over. And then also what's happened is that with all this volatility, there's lots of questions and concerns about investments, active management, buy and hold, long-term strategy. So it's been relatively positive and lots of inquiries from potential clients.
That's really good. You said, sorry. Oh, wow. I've had a lot of people on. I've had some people on the podcast the last couple of weeks, and we're talking about a different situation. We're talking about being down numbers and being happy being down only a small percentage. So, that seems against the performance of the market and other people that I've been speaking to. Is that any particular reason for that?
Well, I think it really comes down to process, and I think being in investment management, portfolio management, and managing other people's money is probably one of the toughest careers and jobs out there that you can do. It's really structured in a way to make success the most difficult. And when I say that, there's just so many different moving parts, so many different ways you could be looking at companies, valuations, and opportunities. You have to have really thick skin. You really need to be independent as well in your thought process and your conviction to do what is right. But at the same time, you have to do it every day, and there's a short-term and a medium-term kind of requirement as well. So really balancing all that is really challenging. But what I've been able to do is really develop a process around the business cycle, and it really comes down to two things. And it's helped me stay on the right side for most of my career. That's really the change in the cost of money and the change in the cost of goods as it applies to both consumers and businesses. So when I say that, really what I'm talking about is that if you look at where interest rates are today, they impact the economy 18 months from now. And where we are today is a result of where interest rates were 18 months ago. And 18 months ago, what was happening was central banks were really raising interest rates when they shouldn't have. And that really started to put the brakes on the economy. We started to see that filter through all through 2019. And then the big catalyst happened in March of this year with the COVID virus and shutting down of many economies. So there's all kind of part and parcel, and everything kind of came together for that. And our cycle analysis was showing highlighted risks or elevated risks.
Okay, can you break down your cycle analysis that a little bit more? Can you give us an idea of what that exactly looks like, or what that is?
Sure. So I developed this process that really focuses on total return. And what I mean total return is how do you reduce kind of the drawdowns and the downside of your portfolio while trying to capture the upside. And essentially what I do is I break down different asset classes, whether it's equities, whether it's fixed income securities like government bonds, or commodities and currencies as well, into different time period cycles. So short, medium, and long term in the simplest forms. And what you have is you create these statistics and historical comparables that you can go back to. And when certain things line up, then you have high probability, lower risk entry points. And you can do this for different time frames. So whether it's on a daily, a monthly, or you have a longer term time frame. And I've been able to adjust this and dynamically work across that process. And really what happened was, after spending a lot of time, the better part of 16 years with larger investment firms, I was frustrated with the restrictive rules that they had, and they didn't really make sense to me from both risk and return profile. And I didn't really fit the corporate mold either, because I was looking at things from a little bit of a different angle. And through that, what really happened was I was able to develop this total return investor cycles and trend process.
Okay, you make it sound relatively simple, but I can imagine that it's pretty complex.
Well, Sean, usually the simplest things take the most amount of time, right? To really make sure you're covering all your bases. So it's not exactly simple. What I've done is I've taken 4 different investment disciplines. You have macroeconomic research, fundamental bottom-up research, and then I look at technical analysis with price action on charts, and then also look at quantitative, which is a bit more statistical. So that's really 4 different hats you have to put together. And it was really in the second year of when I was trying to manage money that I got into a little bit of a challenge where, fundamentally I was doing really well, but from the timing perspective, not so good. So with learning all these different principles and bringing the 4 different types of thinking together, I was able to fine-tune this process. And it really started back in university. So I always knew I wanted to be in business. And when I was back at SFU, excuse me, one second. When I was back in at SFU, I first started off as sciences, and I wanted to shift towards business. I went to the counselor there, and the counselor asked, what's your goals? I said, I want to get into business school. And they said, well, given where you are, where your grades are, et cetera, you'll have to change programs or you have to change schools. And that kind of really lit a fire under me. And a couple of years later, I finished my business degree there. And I also finished my MBA as well. So that was that work ethic that I learned early on and applied it to the markets. And then with this cycle process as well, it's really about consistency. And you have markets that sometimes are up, sometimes are down, sometimes they go sideways. But if you don't have that consistent process, you'll always be challenged and always be reactive. And then the last thing is, if you think about the business cycle or the macroeconomic environment, which a lot of investment advisors or portfolio managers aren't well versed in, really it explains 75 to 80% of the market moves. So if you have a good understanding of that, then you can navigate through these challenging times.
Okay. So do you have a background in that? Like, what does it take to develop a process like this?
It's lots of varied experience, right? And lots of time. So I spent hours and hours fine tuning this. So as a young kid, I grew up in a small town in British Columbia, small town BC, Mackenzie, BC. It was your typical resource town. My parents are immigrants from India. Growing up in the 80s, it was probably the best experience and the best childhood a kid could have. You had 4 seasons. You had winter with 6 to 10 feet of snow in the summers. You had 18 hours of sunlight. So, in a town of 4,000 people in a good year, and is also located on a dead end, so not very many tourists or people came in. You actually had to go off the main highway about 25 minutes to get to our town. So it was a great experience growing up, but it also limited you in a lot of ways, right? Had no access or very limited access to information. There's no internet back then, in the late 80s, early 90s, no emails, really no access to mentors or people in the industry that could provide insight or advice. So as I moved to Vancouver and started going to university, by default almost, I started off in sciences and then quickly found out that, chemistry lab work wasn't for me. And that's when I shifted over and did an undergrad in finance and economics, then completed my CFA as a charter holder and my MBA as well to get that technical and educational kind of background.
Okay, so obviously you've got the education, the degrees, kind of everything else there in play, but in relation to your background, what did your career trajectory look like work-wise?
Oh, I've done a little bit of everything. So I think I've been very lucky to be a generalist in a way. So, I started off in high school piling lumber in a sawmill. Later on, kind of mid-career, I was making underwear in Central America, and we're selling it all over the world. And then I've spent about 15 years managing money. So again, I've been very, very lucky with my work experience. Right out of university, I got to work on the regulatory side with the stock exchange and corporate finance. Did a stint with an investment bank on the sell side, and then the buy side experience as well. Working for industry as well as a CFO, manufacturing kind of unique fun underwear was quite the experience as well. Seen and done things that you wouldn't imagine, or but it brings it all together, because then as an investor, you learn to spot a lot of red flags. You understand how bankers think, you understand how the regulators think, you understand clients, you understand branding, consumer demand. So this all applies into what's actually happening now with the economy slowing down. What's consumer sentiment going to do? When are people going to get back to vacations and traveling? And even more important than that, what's the challenge with the potential supply chain, right? A couple of months ago, there's a big rush for people to buy toilet paper. So did that really make sense or not? Now we're having challenges in the US. They closed down some big meat processing facilities, right? So this all plays into consumer sentiment and ultimately demand and ultimately stock prices.
Okay.
So didn't really stop there. I also worked with three relatively large, successful investment firms here in Vancouver. And to be honest, learned a lot. But at that point, I wasn't fully ready to launch this business or the strategy. So I did get an opportunity to soak up a lot of information and learn from these investment firms and what they were doing right and how they became successful. And now I brought it together with the total return investor investment process.
So the stock market is, it's an incredible place. It's incredibly fluid, and it's also massive, with the volume of companies that are there. Like, how do you manage all the information in the markets? What's your strategy for that?
Oh, that's a good question, Sean. So what really happens and what a lot of people see is with the market and the amount of information we have, it's like a fire hose of information being shot at you. And so how do you dissect it? How do you organize it? And then how do you actually make a investment in a portfolio out of that? And, the real thing I can say is experience from working in different environments and through different market cycles. Been lucky enough to experience the 2000.com bubble, the housing bubble, the great financial crisis, 2015-16 when oil prices were challenged, and now through this COVID crisis. But I think it also really helps that I have a naturally curious personality. I like to try to figure out how things work, how to connect the dots, and also from a psychology perspective, figure out why people do what they do. And if you can start to understand that, again, you can start to understand what biases we have as individuals and as a society, and then how often we repeat those behaviors, right? So market, it's like everything else in life, they don't go in straight lines, and they're not perfect either because they're inefficient, especially at turning points, right?
How does that then translate into your stock picks? Your portfolio, what you recommend for your clients and for the funds that you manage?
Yeah. So what we do is we try to be objective as possible and understand, again, what's happening in the economy. So everything's driven from the business cycle and where we are. And when we understand that, when the economy is doing well, there's lots of money and liquidity in the system, people are buying, and that usually translates well to asset prices, and markets usually lift higher. And then the opposite is true when things slow down. So we're very transparent, and sometimes in the markets, you make money, and sometimes they go sideways, and sometimes they're down and you're in a bear market. But there's always opportunity to either, preserve your capital or take an active position. So some of the things we did, for example, in the fall of 2018, we're very adamant that the central banks should not be raising rates, and they're making a big policy mistake. So at that point, the long bonds that you could have purchased, for example, the government of Canada or the US 30-year bonds, they're yielding about 2.5% with the coupon. If you had invested in that, we recommended that to a number of clients, your total return over the past 18 months would have been over 24% for a government bond that was 2.5%. So really, if you understand the nature of the underlying investment, there's lots of opportunities. In 2019, we had expected that the markets were going to rally to that 2,800, 3,000 level. They did overshoot to 3,300 into early February, but then they also, dumped back to 2,200 in early March. So really, when it comes down to it, is really that timing and how can you best manage those risks without being super early or super late. So that stock picking really comes to the timing and utilizing our cyclist process for that short, medium, and long-term opportunities.
Okay. So we saw an insane week, this week in the markets, and obviously unprecedented territory with oil going, negative. Like, what's next? Will we see we've got the coronavirus, the world is in semi-lockdown. What do you think is going to happen?
I think it's important for investors to understand there's two different things really happening, right? There's the stock market, and then there's the economy. The both are tied together and connected, but the stock market is always more volatile and goes up and down more than the economy. So we definitely have tough times ahead. Usually what we see in bear markets is you have this quick downdraft, catches most people off guard. And that's what you've seen in March. Then what you have is this reflexive rally that's fueled by hope, by central banks coming in, the government's helping and providing stimulus. And that's where we are in the midst of right now, and that could last for a number of more weeks, maybe even another month, or maybe it could fizzle out here in the next couple of days. And then what you usually have is this drawn out downside that makes the economic fundamentals catch up to valuations. So to be honest, in early 2020, the pendulum had swung pretty far into complacency, right? For companies and individuals. Companies and individuals basically living paycheck to paycheck. Most had less than 2 months of liquid cash to help them in a downturn. And I've learned early in my career, and this is one of the things that really sticks with me, is that liquidity really masks performance. And when you're able to get cash, you can hide your debts, you can pay your bills. But when that liquidity dries up, then the true colors and the strength of the economy and the individual shows up. So really what we need is a reset in the economy here. And it's similar to kind of the forest fires we've seen across the globe. And what happens is when you're trying to overmanage the economy or overmanage forests, etc., the conditions become more and more dangerous. And then sometimes the potential cure is more dangerous than the original cause. And I think we're in a point there where it's going to take a number of months, if not, a year and a half to kind of muddle through this and figure out what the new normal is.
So are you a pessimist or just a realist?
No, I'm not a pessimist at all, but you got to be practical, right? And you're managing individuals' wealth that they've spent years and years building. Again, what we're doing is we're following our process throughout the business cycle. This business cycle is bigger and deeper than many have anticipated. But once we get through it, on the other end, there's huge opportunities for investors, right? Equity markets are likely to rally 40, 50, or 60%. In fact, we've seen that in 2003, we've seen that in 2010, we've seen that in 2016. These cycles tend to repeat, and if you have, again, that process to be able to break down that short, medium, and long term, these cycles expand, sometimes they contract, sometimes there's an extra cycle in one of the time frames, but the form is always the same, right? So that process can really help you sleep at night. So 18 months from now, I think things and expectations of people will be materially different.
Okay.
And more positive.
What would you recommend, people or your clients do right now?
So each client is unique, right, in their needs and their requirements. So the first thing is really to understand what your lifestyle is, what your earnings are, timeline, and also your risk tolerance. So all these things come in together and into play. The next thing is I would encourage investors to be active and be knowledgeable, right? Nothing ever goes in a straight line, and it never hurts to take some profits or some cash off the table. So being a bit more defensive, not necessarily conservative, but defensive, also helps you be more opportunistic and play offense when the opportunities present themselves, right? Also, it's key to really spend some time and understand the investment process your wealth is being invested in, whether it's with a large investment advisor, whether you're doing it yourself. Really, spend the time to understand and be comfortable, or at least spend the time to research the individual that is helping you and managing your wealth. As the legendary coach from the Patriots, Bill Belichick, says, the first step in winning and building wealth, in this case, is not to lose, right? So you don't want to make any show-stopping mistakes.
Yeah.
And I'm available as well if any individuals are interested.
Yeah. Where can people find you?
I can be reached at my email address, rabbie.gill@fieldhousecap.com, at our website, fieldhousecapital.com as well.
Brilliant. So a lot of information to digest there. I think very, very informative for people and incredibly helpful. So thanks again for coming on. Any closing thoughts?
Thanks, Sean. Yeah, I think that for people, they should just remember that markets are not efficient because human nature and psychology isn't rational 100% of the time, right? Humans, we have these biases and we have these linear assumptions. So we really have to have the fortitude and I guess the confidence to be able to look at things more cyclically and up and down and be opportunistic, right? And, you know, it's always important to work with an advisor that understands that business cycle and help you can manage both your personal wealth and even your business or different opportunities you're looking at. So, you know, in closing, Sean, I really want to thank you for having me on here. Hope for good health and success to you and your family going forward, and we all get through this these challenging times.
Yeah, you too, Rabbie. I want to thank you very much for coming on, and maybe if we're in this for a little bit longer, you could come on again sometime.
Yeah, happy to do that.
Wonderful. Rabbie, thank you so much.
Thank you, Sean.
Bye-bye. Thank you.